You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Hey everybody, it is Buck Joffrey here, and today we have kind of a special opportunity to learn about something that I've previously been involved with, which is something called captive insurance. There's got sort of an interesting history behind it, which I'll let the team kind of get into. But in this situation, what I'm going to do is kind of turn it over to Ryan Haley from Valerity Wealth, who works with Zulfi Ali, and he is going to explain kind of what this is all about, and then he's going to introduce our expert guest, who's going to really dive into the weeds. So, Ryan, why don't I pass it over to you? Thanks for doing this.
Yeah, thanks for having us. I'm excited to share this with everybody. So I had heard about this through Jonathan at Unbridled Wealth, which, just to remind listeners, I am kind of dual-hatted, so to speak, as both an insurance agent with Unbridled Wealth and also as a financial planner and investment advisor with Zulfi at Valerity Wealth. So when I heard about this, it just checks a lot of boxes from an overall financial planning standpoint. There's a business management aspect, risk management, tax mitigation, and obviously an investment portfolio and retirement aspect, as well as potentially legacy planning and estate planning. So I'm not going to go too much into the details, but wanted to bring Sean King on, who is the principal of CIC and has a pretty compelling story in an effort he led, and also wanted to at some point let Jonathan share, because he has actually implemented this with one of his clients recently. So I think, if that works for everybody else, I'll just set the stage with that, and then I can kind of chime in as needed. But I think, Sean, you really have a great model, and that has proven itself in a pretty powerful way, as I'll let you share.
Thank you very much. Yeah, I've got a little slide presentation here. I don't plan to hit all the slides today, but we'll focus on some of the important ones. And also feel free to interject at any time with questions as we go. So our firm is CIC Services. We are what in the industry is known as a captive management firm. So you can think of that sort of like a TPA firm, a third-party administration firm, as a TPA firm might be to a health insurance plan or maybe to a 401k plan. We are to captive insurance companies. So our role is really to help clients learn about captive insurance or set up and operate captive insurance companies of various varieties. Again, this is me. I'm Sean. I'm an attorney and a CPA. I have worked in the financial services business my whole career and really focused initially on financial planning, retirement planning, and qualified retirement plans. Over the last 15 years or so, I still do those other things, but I've transitioned more towards focusing on wealth protection planning. How do we help business owners generally, but high net worth individuals also, how do we help them protect their wealth? And as we started doing that, looking at different asset protection strategies, one of the things that rose to the surface quite quickly was captive insurance. And we quickly started doing more and more captive insurance business and realized that, as was just explained, it's a really versatile tool that can check a lot of boxes with sort of one package. And so we began to focus more and more on captive insurance, and it makes up a large part of what we do today. Our team is comprised of several folks. I won't go into detail. Brian Ridgway is our head of operations and one of the managing partners of the firm. Randy Sadler is another managing partner of the firm and heads up primarily our new business efforts and client education efforts. So let's begin with the big picture. What is a captive insurance company? And you can think of a captive insurance company really as just a closely held insurance company. It's an insurance company that's real or intended to be real in the sense that it issues real policies to insure real risks and builds up assets, reserves to back the potential liabilities under those policies. A captive what makes a captive is that it's generally owned by the same economic interests that own its primary insureds. So you may have an operating business that's working in any industry, construction or whatever, and that business has risk, and it creates, or its owners create, a separate insurance company that exists to insure primarily, though not exclusively, the risks of that related business. They've been around since the 50s, and they really insure risks in pretty much every industry and sector today. They can be used in a lot of different ways. Captive insurance is a very broad umbrella. They can be used to replace various types of commercial insurance. That can involve replacing entire policies that were previously purchased through a third-party commercial carrier with policies that are instead purchased from your own captive insurance company. But it can also involve sort of going halvesies on that, right? Like keeping some of your commercial insurance, but increasing the deductible by a whole lot, and then insuring that deductible through the captive insurance company. Another thing that captives can do is they can be used to insure what we call enterprise risks. Enterprise risks are the risks in a business that are commonly not insured at all, or if they are severely underinsured. And we'll talk more about that and give some examples of that in a minute. They're great with warranties if you have clients who are car dealers or equipment distributors or work in other industries that commonly provide warranties to their customers. Using a captive can be a much more tax efficient way of doing that, and it can also be a better asset protected way of doing that. And they can be used several other ways as well, but those are the primary ways that you'll commonly see and may have already seen. So most of our clients are using captives, at least in part, to insure what we call enterprise risks. So what are enterprise risks and why should businesses take them seriously? The answer is that small and mid-market businesses, which are our primary clients, we're typically not working with Fortune 1000 companies. Small and mid-market businesses are uniquely fragile when compared to, say, Fortune 1000 companies or much larger business. And they're fragile for at least three main reasons. Number one, they lack access to credit and capital markets. If cash flow runs tight, if they run low on cash, unlike a Fortune 1000 company or they can't just go and float some more bonds or easily dilute existing shareholders and raise more capital by issuing more shares, right? They've got to count on a bank or some other lender making capital available for them. And that's not a guarantee by any means. And so you compared to Fortune 1000 companies, they lack access to credit and capital. And that's a huge risk that can cause things that would normally be, maybe knock a few dollars off the earnings per share of a Fortune 1000 company. It can make that into an existential risk for our clients. Also, they're geographically concentrated, right? A Fortune 1000 company can have a hurricane go through a particular area of the country, and it might disrupt some distributions or some of its manufacturing, but normally it's geographically spread out, and it's going to be able to survive that. Might take an economic hit, but it's going to survive. Not necessarily true with a lot of small and mid-market businesses. When Hurricane Sandy went through, for example, up in the Northeast, thousands of small and mid-market businesses, some of which had been around for decades, were wiped out, and many of them never really made it back. And then lastly, small and mid-market businesses often have concentrated revenue streams. A Fortune 1000 company might earn revenue from thousands or even millions of different customers. It might have different divisions that generate revenues in different ways. Small and mid-market companies usually have, it's not unusual for them to earn 50, 60, 80% of their revenue from only a few key contracts with a few key customers, and or they have a business model that's 80% dependent on a few key suppliers. And so they have very concentrated revenue streams. And it's for those reasons, perhaps, that, and this is not a statistic that'll be surprising to any of you guys who do this for a living, but 40% of small businesses affected by natural or human disasters never reopen their doors, according to the Small Business Administration. And that's one reason why, only 30% of family-owned businesses survive into the second generation. Estate taxes and other things are other reasons, but this is one of them. If you have a low frequency but high severity loss, something that doesn't happen very often, but when it does, it's devastating. The odds of that happening in any given year are tiny, but the odds of that happening, say, over the course of your whole generation of your business aren't all that tiny. And so taking those risks seriously and preparing for them can be very important. And yet, small and mid-market businesses are really the backbone of our economy here in the U.S. Politicians say that all the time. Small businesses are the backbone of our nation's economy. It's more than just the talking point. It's actually very true. They account for about 99.7% of all employment in the country, or employers, I should say. They employ nearly half of all private sector workers in the country. They generate about 2/3 of the net new jobs created over the last 17 or so years. And they make up about 97.5% of all identified exporters in the country. So they really are important. So what happens when you have businesses that are very important to the overall economy, but also very fragile? Well, you've got a situation where if things go wrong, it could be very, very bad for the country as a whole. And this is why I think Congress has passed laws to really help small and mid-market businesses protect against the types of risks that can be absolutely devastating for them. This is a chart that was taken from ready.gov, which is the Department of Homeland Security's disaster preparedness website. And you can see here that it's really encouraging small and mid-market businesses to prepare for, to plan around, and to insure against a variety of different risks. And you'll see some of them noted there on the far left under hazards. And there are some things in there that most businesses are woefully unprotected. Utility outage. What happens if there's a long-term power outage due to maybe a terrorist attack or declining power grid? What happens if there's a supply chain failure, cyber attack, and pandemic disease? I used to, when I used to review this chart with business owners, they're like, yeah, those are risks, sure, but very, very unlikely, right? I don't have to have that conversation anymore after COVID. Many business owners either went bankrupt or nearly went bankrupt, or would have definitely gone bankrupt if they hadn't gotten the PPP money and other government bailouts. Or if they weren't in that position, they know very closely other business owners who were. And so it's not the same difficulty today to convince business owners that they need to take these risks seriously. Most of them are already, in some cases, losing sleep at night. So what did Congress do to really make it easier for small and mid-market businesses to protect against these risks? Well, one of the things they did was they provided certain tax benefits. We'll talk more about what those tax benefits are here in a minute, but to illustrate the impact of them, we want to compare two businesses here on this chart. One is a business we're calling the status quo business. It, like most every other business out there, insures the things that it's legally required to insure, and or that lenders make it insure. Things like workers' comp, general liability, automobile insurance, those sort of things. And then on the right, we have an identically situated business. It insures those things, but it also insures all of those things listed there in green via its own captive insurance company. Now, we're assuming here in this example that both of these businesses are identical in every way, including the fact that they have 1 million per year of a risk management budget. So each of these businesses can afford to set aside up to 1 million a year to plan around or protect against these risks. The business on the left just takes that million a year of profit, pays taxes on it, sets it aside in retained earnings for a rainy day. And after 10 years, it will have accumulated about $6.2 million. The business on the right takes that same $1 million, pays it over in premiums to a captive insurance company. If that captive insurance company is legitimately an insurance company for federal income tax purposes, it can take that money in, if it's made the 831B election that we'll talk about in a minute, in a 0% tax bracket. And if it invests in an asset that grows tax deferred, it can have tax deferred earnings as well. And so using the same $1 million over that 10-year period, we end up having about 10.3 million set aside in reserves after tax to cover these future risks and future contingencies. Whereas on the left, we only had 6.2 million. And so the rhetorical question is, which of these two businesses is better off? The one that has less capital reserves and less insurance, or the one on the right that has more capital reserves when we count the insurance company and more insurance coverage? And I think we'd all agree the business on the right is better prepared to survive any number of unexpected contingencies. And that's the opportunity that captives offer. That's literally it. We've got to be prepared to set aside and depart with some cash flow today and let it grow inside of our insurance company. But if we do that, we can accumulate a lot more capital, have a lot more risks insured. And that is precisely why Congress really wanted to make 831B available to the public, to incentivize small and mid-market businesses that otherwise wouldn't be able to economically afford insuring these risks, to give them a way that they can do it and to give them an incentive to do it.
I would just say, just to set the stage for who would be eligible for this and listening, could you give us an idea of who this would be a good program for, who would not qualify, just in case people are, like if, for instance, you've got a high paid W-2, a doctor, or, high paid professional, would that work? Or does this need to be a certain type of business, certain type of revenue, et cetera?
Great question. So it is businesses that set up captive insurance companies typically, and almost universally. So if you're a W-2 employee, you really can't really set up a captive insurance company to insure your home or your car or stuff like that. So this is going to be operating businesses that have risk that are using captives to insure those risks. The nature of the business really isn't relevant as long as the business does have meaningful amounts of risk. And we'll talk about what some of those are. So it could be construction, it could be environmental cleanup, it could be trucking, it could be real estate development, it could be a law firm, a doctor's office. It could be literally anything, but it does generally need to be a business. For it to make sense to do a captive insurance company, you're generally going to need to have a business that can pay a minimum of about $300,000 per year in premiums. If it can't have a risk management budget of at least $300,000 per year, if it can't generate enough cash flow to do that, then probably not a good candidate for a captive. Secondly, the business needs to have risk, as we talked about earlier, and we'll talk about what some of those risks are. Third, ideally, it's a business that has relatively few owners. If you've got a doctor's practice with 50 doctors in it and they all have a vote in what that practice does and doesn't do, trying to educate 50 doctors on anything is going to be like herding cats, right? So ideally, you're looking for closely held sort of family businesses that have a limited number of owners, and ideally a single or a handful at least of decision makers. And then lastly, the business owner needs to have some tolerance for complexity. Captives are no more complex than setting up and operating a 401k is. In fact, at the end of the day, they're less complex, significantly so. But if you have a business owner who just can't be bothered to set up a retirement plan for his employees because it's too much of a headache and a hassle and yada, yada, probably not a very good candidate for a captive. So at least 300,000 of free cash flow in a business or industry with risk, with a relatively small number of decision makers, and where those decision makers do have some tolerance for complexity. That's really the ideal prospect for.
What
about top line revenue minimum? I mean, obviously there's lots of different kinds of businesses now. I mean, some people have businesses that generate a lot of cash. They don't have a lot of overhead, and they don't have a lot of employees. Does it matter what the top line is at all? At least, in terms of underwriting, I presume there probably would be some issues there.
Only in the sense that the top line revenue is going to dictate in part how much free cash flow the business is able to produce each year and how much risk it has. Generally, if top line revenue is less than $5 million, you're probably not going to have enough risk in that business to justify doing a captive. Mm-hmm. We do them down to like 3 million or so, but you're going to be in the multiple millions of dollars of revenue typically if you're going to be doing a captive insurance company and have it be economically.
Well, the reason I bring that up is that, I think, Sean, what you know as well as I do, you're dealing with a lot of people these days that are selling information, and there's not a lot of overhead. And so you could have a business that is generating $4 million, but $3.5 million could be completely to the bottom line. So yeah, that's kind of what I'm getting at. Are those? I mean, that's a very common scenario actually these days. Yeah. So are those people not qualified because their top line is not high enough?
I wouldn't rule them out. I would at least do a little more diligence. It really depends on the amount of risk. If it's a business that's just trading in data and they just have 1 or 2 employees, and it's going to be more difficult to find the risk in all likelihood to have the risk exposure to generate sufficient premiums. But that's not always the case. There are certainly instances, and we'll talk about what some of these risks are in a minute, where even a business like that could have a lot of insurable risk that would generate a lot of premium for the captive insurance company. So I wouldn't rule it out, but that's not the market that I would be actively targeting if I was out there marketing captive insurance companies.
Sean, I've got a couple of questions as well, but I also wanted to just comment because so for us at Unbridled, we have a number of small businesses, and in the last few years alone, we've had over $500,000 lost due to cyber attacks. Obviously, COVID-19 was a huge disruption. I remember we had one customer that was, I think, actually the majority of our revenue at the time that we lost. And so a lot of these things were not insured. This would have been a really helpful strategy for us back then. But the question is going to be, so we have 32 different companies, many of which would not qualify from an income standpoint. But if you have a family of companies, is there a way to do kind of a shared captive across those so you can allow some of those smaller businesses to participate?
Absolutely. Good point. Yep, definitely. If you have a group of companies, if they have sufficiently common ownership across those companies, then yes, they could potentially share a captive insurance company, and that would make it viable for even some of the smaller businesses in the group to participate in it.
Jonathan, I think what your question was, and maybe I'm misunderstanding, but it's a good one, which is like, if Jonathan has a pool of people with different companies that they're not owned by the same person, but they are all interested in captives and can be the decision maker for their own company. Isn't that what you're asking, Jonathan? Is there a way to effectively have a way to pool those people together?
That was actually going to be my follow-up question. Originally, with Unbridled, we do have shared ownership, so there is one common owner across all companies. But to your point, Buck, like if you and I were having this conversation of like, hey, we could both do maybe 200,000 each, but not 300 each, then yeah, would that be an option that me and Buck could go into 50-50 on a captive to meet those qualifications?
Technically, yes. That's not a type of business that I would encourage you to look for, and it's not one that we're really looking to grow in, and normally won't take those type of clients. And there's a very large variety of reasons for that. When you get more and more owners in a single captive, it just gets to be more complex. There's the more potential for disagreement. There's more education that we have to do to different parties. But one of the bigger ones, and we'll talk about this in a minute, is IRS hostility. The IRS has really been improperly, illegally, in some ways, hostile towards captive insurance companies. And while the industry has made great strides in fending them off, and we'll talk about our court case that went all the way to the U.S. Supreme Court here in a minute, though the industry has made great strides, the IRS is still on the attack to some degree. And if you have a captive that has, let's say, 5 unrelated owners in it, the odds of that captive getting audited just went up by at least 5x, right? Because if one of those clients get audited, probably the captive's going to be discovered. They're then going to audit the captive. They're then going to learn about the other 4 businesses that are participating. They're then going to audit those other 4 businesses. And defending those audits when you have multiple owners like that just gets to be really costly. So yes, it can be done. There's certainly nothing wrong about it. But as a practical matter, until the IRS gets more reasonable, and I think maybe they will under Trump, but until they do, it's not the market that I would be hunting in. All right, well, let's talk about what some of these risks are. When we first start talking with business owners, we'll sit down with a blank sheet of paper and just brainstorm with them about what are some of the risk things that can go wrong that would cost you a lot of money. And we'll typically end up with a really long list. And it's usually only a small percentage, represented by the green box here in this chart, of those risks that they're actively currently insuring, usually via a third-party unrelated insurance company. The majority of the risks, in fact, the biggest risks, the risks that keep the business owner up at night the most, are usually completely uninsured or significantly underinsured. And let's talk about 2 varieties of those. The first is what we call operational risk. This is the risk of something going wrong within the business itself that ends up triggering liability or ends up causing it to lose revenue, basically to lose profits. Let's talk about a couple of those. One of those is administrative actions risk. This is the risk of some governmental regulator, state, local, or federal, coming in and auditing your business, suspending your license, jerking your license, doing something that costs a whole lot of money. If you're operating a restaurant, and you're hiring a bunch of 18-year-old servers, and let's just say that one of those 18-year-old servers fails to card a customer one too many times ordering alcohol, and you lose your liquor's license or have it suspended, right? That can devastate a restaurant business. I mean, they make nearly all of their profits on alcohol typically, not so much on food. So that would be an example of an administrative action. Another example would be during COVID. You may remember that some regulatory agencies at the state level ended up requiring medical groups, for example, to stop doing voluntary medical procedures while they were conserving personal protective equipment, masks and gloves and all of that sort of stuff. PPE, yeah. And we had some physician clients who were surgeons, plastic surgeons, et cetera, and they basically just had to stop for weeks and months. It cost them a lot of money. So that's an example potentially of an administrative action. You mentioned cyber risk before. That's certainly a huge one. You can get commercial cyber risk coverage, but Those policies are typically riddled with limitations and exclusions. Certainly coverage you can get through your own captive is typically going to be much more comprehensive. Reputational damages is another really big one. This is just something going wrong in your business that destroys your reputation and causes you customers. We had a large orthopedic surgeon in rural South Georgia who one day the police officer showed up at his office and arrested his physician's assistant, walked him out in handcuffs. The local newspaper covered the story. Well, it turns out that the physician's assistant was dealing pain pills out the back door. This was unbeknown to the doctor, but the local paper ran a story suggesting that the doctor was involved. And almost overnight, his patient load dropped by, over a third. He had to hire a public relations firm and spend a lot of money to rehabilitate his reputation, even though he didn't actually do anything wrong. You may remember, some of us are old enough to remember way back in the day, the Wendy's restaurant finger in the chili incident. Supposedly, a customer claimed to have found a human finger in the Wendy's chili. This was all over the nightly news. Devastated Wendy's business for a long time. Some franchisees never completely recovered from that event, and it turned out, I believe, not to even be true. So those are examples of reputational damages. It can play out in construction. It can play out in pretty much any industry. And then the next big category of risk is what we call strategic risk. This is the risk of something going wrong, not in your business per se, but out there in the world, outside of your business, that ends up costing you a lot of money, either in the form of lost revenue or increased expenses. Business interruption is key here. So many businesses experienced that during COVID. Any business that relied on an Asian supply chain during COVID had significant business interruptions. So that's certainly one of them. Loss of a key customer and or key supplier is another one. As I said before, it's not unusual for distributors, for example, to rely on just a couple of key contracts. If you own an automobile dealership, your whole dealership depends on a few contracts with a couple different manufacturers. And if you lose those, and some dealers did lose those during the financial crisis, some of the automobile companies used the financial crisis as an excuse to cancel those contracts that had been in the family sometimes for generations. So that's another example. Kidnap and ransom, supply chain disruption we talked about already, regulatory and legislative changes, that's a huge one. That's the risk of some law changing or some regulation being passed that basically renders your business model either obsolete or significantly less profitable than it was before. Those are all risks that you can insure for. These are the types of risks that keep business owners awake at night. I don't know any business owner who loses sleep about their auto insurance or their umbrella or their property or their general liability. But these other types of risks definitely keep small and mid-market business owners up. And when you have conversations about them, it's an easy scab to sort of pick at to really get their attention. And when they understand not only that they can insure these risks, but that they can insure it through an insurance company that they own and control, and they can potentially do it in a very tax-favored way, they suddenly get pretty excited about it. So thanks to COVID, as bad as it was, this is increasingly an easy conversation to have. And then once we help the client form a captive, their depth of coverage chart ends up looking more something like this, where before they had only insured the core risks, now they have both the operational and strategic risks insured as well.
And I think another risk that you're probably getting to here, Sean, is something that a lot of people, especially I know in the Wealth Formula Network, have dealt with is audit risk from the IRS and, for instance, conservation easements, for getting tax breaks. And a lot of those came under fire. There's, kind of the IRS top 10 hit list of things that they're looking for. And this, I think, has been on that list and may even still be. So for anybody who's listening and is, experienced that or heard about it and is concerned about it, that's why I really wanted you personally, Sean, to highlight your incredible effort and victory that we mentioned earlier, where you took this all the way to the U.S. Supreme Court and won against the IRS in 2021.
Yeah, thank you for that. Let's talk about that. The issue with captive insurance companies ultimately is whether or not it's a legitimate insurance company. That's it. The Internal Revenue Code, unfortunately, does not define what counts as insurance and what doesn't count as insurance. And so the courts over many years have developed some rather vague criteria to decide, and subjective criteria to some degree, to decide what does count as a real insurance company and what doesn't count. There are several prongs to that criteria, but I'll cover three of them here, and then I'll explain how the IRS goes about attacking these structures. So the first one is capitalization. It's important that when you form your captive insurance company that you put up a meaningful amount of capital day one before it even starts issuing policies. The IRS wants to see that it's well capitalized. In most jurisdictions today, for the smaller variety of captives, that's typically around $250,000 of capital. That can be cash, that can be other liquid assets, it can even be a letter of credit in some instances. So it needs to be capitalized. The second thing is risk shifting. The captive insurance company the business needs to actually contractually shift real relevant risk from itself over to the captive insurance company via the policy contract. You'll sometimes have businesses, kind of insure risks that just aren't real, right? Like if you're getting, well, it's hard to say, but if you're insuring risks that just aren't real and relevant to your business, if you're a doctor's office and you're wanting to insure against, construction defect, you're not in the construction business, well, that's not going to fly, right? So it has to shift real relevant risk. And then lastly is risk distribution, meaning that the captive insurance company has to spread its risk among a sufficient number, and what that sufficient number is part of the subjectivity of this, among a sufficient number of risks and insureds. So if your captive insurance company only insures your business for one type of risk, probably not going to be deemed to be a real insurance company for federal income tax purposes because it doesn't have sufficient risk distribution. You're not spreading the risk among a number of risk exposure units and insureds. So those are sort of the big picture requirements. There are some other smaller details too. The IRS, unfortunately, has just been truly abusive in coming after captive insurance companies. They went after captives in the 70s, 70s and 80s, hot and heavy, and they lost nearly every court case of consequence. They sort of licked their wounds until about the mid-2000s, after which they decided to start attacking captives again, but this time they started attacking the smaller variety, the 831B electing variety that most small and mid-market businesses use, instead of the larger variety. And they found that in that smaller variety of captive, they had some advantages. The IRS did. Number one, people there were just sloppier than Fortune 1000 companies who had captives were. And so they found it easier to make arguments based on the sloppiness that this is not a real insurance company. But more than the sloppiness, they found that most business owners just don't have the stomach or the capital in some cases to be interested in a fight. And so if the IRS just comes in, they can issue a notice of deficiency that just makes the most BS, ridiculous, improper, and inaccurate assertions. And then the business owner either has to pay the tax or negotiate a settlement or go to court. And the IRS knows that in this smaller captive market, not too many are going to be willing to go to court. And so they use that basically to extort settlements out of clients. And I don't use that term figuratively. I mean, literally, to extort settlements out of clients. To give you just one example of how egregious they can be in some circumstances, we had a client who formed a captive insurance company, perfectly legitimate, insured a large variety of risks. The very first year of its existence, the captive insurance company had a $600,000 claim on loss of a key customer. Big claim that got paid. And the IRS came in a year later, audited that captive, and ended up saying in their notice of deficiency that the captive had never paid any claims. That was one of the statements in their notice of deficiency. Completely false. They paid claims every year of its existence. Not only did they pay claims related to their own captive, but they also paid claims related as a reinsurer for unrelated captives, including that $600,000 claim. And the IRS just took the position that no claims. And they knew it was wrong, but they didn't care because they knew that in all likelihood, this client wasn't going to spend the money to take them to court and win. And they didn't. The client ended up negotiating a settlement with the IRS, and it was a reasonable settlement. But the IRS definitely got more than they legally had a right to get to. So that's one of the ways they've been abusive. Another is that in 2016, they issued a notice, 2016-66. And this is where our Supreme Court case comes in. That notice imposed upon captive managers like us and upon businesses that have captives some really onerous, burdensome record keeping and filing requirements. Every year, the business would have to disclose its participation in the captive. It had to make an initial filing with the IRS going back 10 years that provided a huge amount of data on all captive transactions over the prior 10 years. And failure to comply with this requirement intentionally could subject you even to prison. Even doing it unintentionally could subject you to a $50,000 per year fine. So the IRS issued that regulation, but it didn't follow the law. It didn't follow what's called notice and comment rulemaking as required by the Administrative Procedures Act. And as a result, the law was illegal. We sued the IRS. Our captive management firm sued the IRS, saying that, no, this is an illegal rule. You didn't follow the proper procedures. It's arbitrary and capricious, et cetera. Unfortunately, the IRS came back, and you'll never believe what they argued. What they argued was, Judge, we're not denying that what these guys are saying is true, but there's this old law from the Civil War called the Anti-Injunction Act that says that no district court can restrain the assessment or collection of a tax. So the only option for CIC services, if it wants to challenge this rule, is to break the law, risk going to prison, pay a fine, and then sue for a refund. And if it does that and wins the lawsuit, then you can say that the rule, that the law is not valid.
So this is where the extortion comes in that you mentioned earlier.
Exactly. So we said, Judge, that's not the law. That's not right. Unfortunately, the district court agreed with the IRS. We then appealed to the Sixth Circuit. We lost 2-1 at the Sixth Circuit panel. We then asked for an en banc review by the Sixth Circuit, which is rarely granted, but it was. We lost it 8-7, with one of the judges who wrote with the majority writing separately to say that he actually felt like that we had the winning side of the argument, but that he was going to rule with the majority because that was the best chance of getting this heard by the Supreme Court, and it needed to be heard by the Supreme Court. So we then petitioned the Supreme Court, and the Supreme Court hears a tiny, tiny fraction of all the cases that it's requested to hear each year. And by some miracle, it agreed to hear our case. And not only did it hear our case, but it ended up ruling 9-0 that the IRS's position was wrong, that indeed we could challenge the rule without having to break the law, risk imprisonment, and pay a $50,000 fine and sue for a refund. So that case then got remanded back to the district court for further proceedings. The district court then ruled a few months later that the whole Notice 2016-66, which had been in existence for 6 years at that point and had cost the industry and clients millions of dollars in compliance costs, was indeed illegal, that the IRS did not follow proper procedure, and in fact that the law was arbitrary and capricious in the sense that the IRS's whole justification for the law was that the industry had been abusing these structures. When the court looked at the actual evidence and the administrative record of abuse, the IRS had literally nothing, no evidence that the industry was actually abusing these things. So we ended up winning. 2016-66 was overturned and is no longer the law. And now we're still in a position where the IRS is, at least for the moment, hostile, though we have some hope that the Trump administration will take a different view. But we've deprived them of some of their more silly arguments, like the Anti-Injunction Act. And clients are now well positioned to defend themselves if the IRS comes after them. And our case actually did have a lot of precedential value. You mentioned the charitable easements earlier. There have been victories won in that space that refer directly back to our case as prior precedent. So it was an important case in not just the captive insurance business, but it was important in that it deprived the IRS of an abusive tool that it was using, the Anti-Injunction Act, to prevent taxpayers from ever even getting their day in court, which is hard to believe that would even be a debatable question, whether a taxpayer should be able to have a right to a day in court. But believe it or not, the IRS's position was, nope, until you break the law and we decide to come after you and you decide to pay a penalty and then sue for a refund, you don't get a day in court. So fortunately, that rule was done away with.
I mean, I think this strategy has always been fascinating to me, and obviously really appealing for several reasons. Obviously, some of the tax benefits, but of course the insurance aspect as well. For, like I mentioned, with a lot of our companies, this would have been a huge benefit for us. I was actually talking with a client of Unbridled Wealth a couple of months ago, and my confidence in captive, I think you called yourself a captive manager, Sean. My confidence in them has always been pretty low. And so to see the credibility of a firm like CIC Services having the chutzpah to take the IRS all the way to the Supreme Court and win really gave me a lot of confidence. And so when I was talking to this client, like we make it a point with our clients to, when we're advising as Unbridled Wealth, that we're not recommending specific investments or specific services, but instead we really like introducing good people and good companies. And when I brought CIC Services into the conversation, they really took over and were able to explain to, in this case, it was a construction company with really good profit. They had it was new to them making that much money, but they had a lot of risk outside of their core insurance needs. And the ability for them to start their captive, pay premiums, which, and correct me if I'm wrong, Sean, it ended up being an expense to the business that year, so it reduced tax liability. And with the 831B election, that entity did not have a tax burden on the money coming in. So there's a lot of efficiency created there. And then their plan is to obviously continue funding those premiums. But I believe there's even flexibility of making distributions from that entity down the road. If they end up having a surplus, there can be investments within it. I think even potentially life insurance owned by it. Maybe good for you to touch on a couple of those aspects, Sean. But I honestly just wanted to give an endorsement that for my experience so far with CIC services has been really positive, and their ability to come in and educate the clients that this really could be a good fit for them. And again, for me, I really wish Unbridled had been introduced to a firm like this 4 or 5 years ago before we had some of those huge losses.
Well, thank you for that. Truly means a lot, and we work hard to get exactly that sort of feedback. So it's really rewarding when we manage to get it. And sorry about your all's firm's losses. I mean, yeah, these are very real risks, and they're risks that most businesses are not insured on at all. And they can be insured through a captive insurance company with extraordinary potential economic and tax benefits, as you alluded to. So thank you for that.
And am I correct in saying, I just want to make sure I was accurate in that when the company pays the premium to their captive, it's a straight loss or expense to the business, and then with the 831B election, that entity would not pay any tax on the premium coming in. Is that correct?
Exactly. So 831B says if you elect 831B and you qualify for it, which among other things means you have to be a legitimate insurance company for federal income tax purposes, your insurance company gets to take all premium dollars in a 0% tax bracket. And that can be up to, what is it now, 2.6 or 2.7 million per year, something like that, is the maximum amount under 831B. You'd have to be a bigger business with lots of risks to ever get that level of premium. But imagine being able to write a check from your left pocket, your operating business, for say $2 million in premiums, over to your right pocket, your captive insurance company that you own. Your operating business gets a $2 million deduction, just as if it had paid premiums to State Farm or Lloyd's of London or some third-party insurer to insure those risks. And your captive insurance company takes that money in a 0% tax bracket. Truly amazing tax savings opportunities. I mean, in that scenario, by the time you count federal, state, and local taxes, you're probably looking at over $1 million a year of tax savings. So potentially very large, and the insurance benefits are potentially enormous in terms of keeping businesses in business when things go wrong.
Yeah, that's awesome. That to me was one of the huge factors. So I'm glad you touched on that.
Okay, so I'm gonna sort of represent the audience here, and just for perspective, Sean, I have been sharing these types of things. Actually, we've even talked about captive insurance before, even as far back as 2016 and 2017. And I also had a captive myself for a period of time, have not used the strategy for years, in part because of what you just talked about, which is sort of a very aggressive stance from the IRS, and the IRS listing it as what is it, the transactions, a listed transaction. They've put captives on their, they have that list of the
dirty dozen,
the dozen. And so your story of the the issues with the IRS are probably the main reason, or there certainly are the main reason why people have resisted continuing to use these types of things. There are, again, a number of people in my investor group that have used them in the past. So I guess knowing that, what do you say to somebody who's like, I love the idea, but I'm still not, and I love that they beat the IRS in a case in court, but does that help me any? Because the situation still remains the same. The IRS knows that a lot of times they just go after people, and the next thing you know, it's like you're dealing with a gorilla, and you want to go to court against a gorilla. You're gonna spend a lot of money even if you win. So how do you address that particular issue for people who are interested in this kind of thing?
So lots of layers to that, and it's a great question. First of all is the fact that the IRS is really only targeting 831B electing captives. So you can do a captive, not make the 831B election. So the captive will take money in a taxable bracket instead of in a tax-free bracket, the premium income. And you don't have to really worry much about the IRS. And you get all of the insurance benefits of a captive. You just give up a lot of the potential tax benefits of a captive. And that's still a very viable decision for people who have a lot of anxiety about these risks, who want this sort of insurance coverage, but who fear the IRS. So that's sort of part one. Part two is if you do want to make the 831B election, you got to recognize the upside potential, right? So yes, there is the downside risk of an IRS audit, but there's the upside potential of coming out millions and millions of dollars ahead. And so do you want to have 100% chance of not coming out $1 million ahead? Or do you want to have something less than 100% chance of coming out millions of dollars ahead? And I think, presented that way, most clients, if they have the intestinal fortitude for it, are going to say, well, heck, yeah, I mean, if this is legit, I'm doing this honestly, I'm doing this in good faith, I see the benefits of it, I genuinely am concerned about these risks, I think this is a real legitimate insurance company. I'm going to do it. And if the IRS ends up challenging me, then I'll either negotiate a settlement or I'll fight them and win in court. But that's an if, right? And if they don't audit me, which is actually most likely, we've done hundreds of these transactions and probably less than 20% of our clients have ever been audited, even with all this increased scrutiny. So the odds are you're not going to get audited. And if you do, then you can negotiate a reasonable settlement or take the IRS to court if you want to spend the dollars to potentially fight and win.
And that's where you guys come in too as CIC services, right? Is that you're helping them on the front end to hopefully avoid audit maybe in the first place, but even if they do get audited, because you did everything the right way, you asked the right questions, got all the documentation, you've already been through this, worst case scenario and come out, with an incredible victory. That's, I'm assuming, what the value add that you guys add to somebody who's considering something like this is making sure that they're not sloppy, the mom and pop operators that were just getting bullied and extorted by the IRS, and maybe they weren't following the rules, but you guys are there to help them, through all these questions. If I'm just imagining from the audience standpoint, they might be like, man, I don't know if this works. That's what you guys help them to determine. A, is this even going to be a viable strategy for you and your business and situation? And B, if so, we'll make sure that you're buttoned up so that even if the worst happens, you're, much less likely to have a negative outcome.
Yeah, but that's exactly right. But even to get there, you have to have a client who's willing to argue with the IRS, right? Because the IRS's position isn't necessarily going to be reasonable. The odds of them auditing you, walking in and saying, oh, you guys checked all the boxes, perfect, bye-bye. It's probably not going to happen because they're not acting in good faith here. They're, as I said before, they will completely misrepresent the facts in some cases in order to issue a notice of deficiency, which you then have to, fight them over or concede and negotiate a settlement. But yes, that is our job, is to help make sure that they are in the absolute best position should they choose to fight. And that would be the final point that I would make is if you have a business that's in an industry or you have a business that's already doing some shady stuff unrelated to captives and they're terrified of an IRS audit, probably not a good candidate for the captive. We were working with a junkyard owner once, and by the way, I had no idea how profitable the junkyard business is. I mean, it's ridiculously profitable, but they were doing almost all their business in cash, and they weren't apparently reporting a lot of that cash income. And, they were thrilled about the captive, really excited about it, but they ended up deciding not to proceed because of the increased risk of audit. And they just didn't want to have the IRS coming around when they're already doing shady stuff. But if you're doing legitimate stuff in your business, you're trying to stay your level best to be squeaky clean and do things honestly. The upside potential of a captive is extraordinary. It can literally save your business when the timing's right, and or make you millions that you wouldn't otherwise have. And so given that upside, You just got to measure that and weigh that against the downside risk of an IRS audit and the hassle of that and the argument you might have to make and whether you want to go to court. But most of the time, it's never an issue. Like I said, probably less than 20% of our clients have actually been audited over the 15 years that we've been doing this.
So just to, sorry, go ahead, Buck.
There's a number of questions I'd like to get through because I know my audience is going to do this. So Ryan, let me just pound through some of these if that's okay.
Sure.
One of the questions I'm thinking is, can the captive theoretically actually have insurance against audits, meaning defending the audit? So, because the cost of it is one of the big things that people are going to worry about, like who's, so can you actually use a captive to pay for defending the captive against the IRS?
That's a great question.
Yeah, one of the types of insurance that you can buy from your captive is insurance against the IRS taking an unfavorable position on a tax position that you've taken in the operating business. So yes, that's commonly done, but it'll typically exclude any challenge of the captive itself. And there are various reasons for that. So you typically cannot buy insurance to insure against the risk of loss should the IRS determine that your captive is a bad captive. Having said that, your captive is going to be sitting there typically on a ton of liquidity, right? If the business is being run correctly and the actuaries have done their work, you're typically going to have a highly profitable business that's going to build a lot of retained earnings. So you're going to have, just within the captive itself, plenty of money that otherwise would have gone to pay taxes to the IRS that you can use to argue with the IRS, to defend yourself, to take them to court. You can really play with Uncle Sam's money when you're defending yourself.
Help me understand that, because I thought this is this money is owned by the captive insurance company. So how am I using the reserves to pay for legal costs?
Well, the way the IRS would attack these typically is to attack the captive itself and say that it's not a legitimate insurance company. And so the captive can defend itself, can use its own assets to defend itself in that audit and prove that it is a legitimate.
Okay. That makes more sense. So one thing in terms of the risk side of this, is this pooled risk? I'm assuming that there's multiple captives that are effectively going into a pool, or how is it that you're able to insure? Because typically that's going to require, a pool of money probably somewhere.
Yeah, I didn't get into, we talked about risk distribution briefly, and I didn't get into risk pooling, which is how risk distribution is often achieved for a captive insurance company. It's a longer conversation and one we just didn't have time for today, but the short answer is yes. What you'll see here on this page is you'll see the operating business on the far left pays premiums over to the captive in the middle. The captive then reinsures some of its risk to a risk distribution pool. And ultimately, the impact of that, the significance of that, is that the captive insurance company ends up insuring some of the risk of unrelated businesses, unrelated captives, I should say, as a reinsurer for those unrelated captives, in exchange for those unrelated captives acting as a reinsurer for some of our business's loss here. So if the business in the far left box here, let's say, had a $100,000 loss that's legit and insured, the captive insurance company in the middle is going to pay $49,000 of that loss. And the risk pool on the far right, in the sort of gold-colored box, is going to pay $51,000 of that loss. So that's typically the way the risk pool that our clients participate in works. And it works great because 51% of any losses are typically going to be covered by completely unrelated parties. And in years that your business doesn't have any losses, your captive insurance company is still going to pay its share of some of the pool losses, which is good because that's what helps prove that this really is a legitimate insurance company, because you're covering some insured losses every year. And you're even paying losses for unrelated parties through the risk distribution pool.
What can your insurance company invest in?
Great question. We have a whole presentation on this, but basically it needs to invest in a way that's high liquidity, low volatility or managed volatility, earning a decent return, and ideally that's tax efficient. So that's typically going to be a diversified portfolio of some sort, high liquidity, low volatility, decent return and tax efficiency, but COLI, certain types of corporate owned life insurance, structured the right way, where you have a high early cash surrender values, for example, can be an ideal vehicle for a captive insurance company. It checks all four of those boxes really well. And in some cases, better than pretty much any other alternative investment can for the right insured with the right time horizon.
Which a lot of your listeners, Buck, should probably be familiar with. I know you've been talking a lot about, premium finance IULs, wealth accelerators. So that's definitely something I think a lot of people are hopefully already comfortable and familiar with, if not actually implementing already in their business. So that's, could be part of it, doesn't have to be, but that's definitely something that we can help with on both sides, Unbridled and Valerity together in managing all that.
At a high level, can you just explain why what the advantage of having premium life insurance, premium finance life insurance inside of a policy like this? Why would that be beneficial?
Yeah, about 2/3, last time I checked, of Fortune 1000 companies fund their non-qualified deferred compensation plans for their C-suite executives with at least some high cash surrender value investment grade life insurance. And when you look at banks, banks have what are called tier one capital requirements. It's the most conservative, safest layer of capital. And they have to invest it basically with the same investment mandate: high liquidity, low volatility, decent return, tax efficiency. And they will often use BOLI, or bank-owned life insurance, for that purpose. So in a nutshell, properly designed, we typically use like an equity indexed universal life. So you're going to get equity-based long-term rates of return inside a life insurance contract that's going to grow untaxed. And because it is life insurance and because it has a rather large death benefit associated with it down the road, it can also help facilitate a unique exit from the captive 5, 10, 15 years down the road. That's a whole other presentation, but
I know
the life
that is a
insurance
big
can
one.
facilitate that. Yeah.
Yeah. And I know we can't go into all those details, but I think that's important that you're probably going to get to at some point, Buck. Is so far we've talked about a very effective tax deferral program, but what happens on the backside? Are you on the exit?
Yeah, I think there's a couple of elements I want to specifically address. Is like when I had one of these last time, there was, as I recall, and I don't know if it's appropriate to do necessarily now or high risk, but, you could borrow potentially from the insurance company. The other idea was that, you could potentially do you could have after 10, 15 years or whatever, you don't need the insurance company anymore, and it folds and once it folds, that those reserves essentially somehow come out tax free. I know you don't have a lot of time to talk about it, but I think that's really important to close the loop here.
Yeah, but it would be a whole other presentation to make this make any sense. But the short answer is potentially you're right. Yes, that by using the life insurance, combining it with a family limited partnership where the captive insurance company down the road ends up in former captive insurance company down the road ends up investing its assets into family limited partnership in exchange for limited partnership units. And if that asset is life insurance, if the main asset that gets invested into that FLP is life insurance, then through 2 or 3 other processes, the FLP can borrow against the life insurance. If the FLP is set up right, that results in a step up in basis for the general partner's interest in the FLP. And the FLP can then turn around and distribute that borrowed money against basis to the business owner, and doesn't generate tax at that point. And that does create a negative capital account in the family limited partnership, that will be problematic down the road unless you keep the structure in force until death. If you keep the structure in force until death, the tax-free death benefit comes into the FLP, restores that negative capital account, and essentially we're able to access a lot of the funds in the captive insurance company during the life of the business owner without triggering meaningful additional taxes. So
hence why the IUL is a good vehicle for that, to Buck's earlier question, in addition to potentially other investments. But that's, I think, was an important aspect of how in certain cases you could kind of get the best of all worlds if all the stars align. You know, the deduction on the front end, tax deferred growth, potentially tax-free exit. I know there's a lot. That's a whole huge separate conversation or presentation, like you mentioned, Sean, but I thought that that was a really important thing for a lot of listeners to be aware of. And just since we are kind of coming up on the end of the year for tax planning, I know for a lot of our clients, that's always a busy time. For someone who's listening to this, we're recording this Friday, November 8th. Buck, I'm assuming this will probably be out in a couple days, you know, next week sometime.
Yeah.
So if you're hearing this, say November 12th, you got about 6 weeks to the end of the year, and you're saying, yeah, I think this might work. Is it feasible that they could have all this stuff in place before end of year to benefit for the 2024 tax year?
it's possible, but we would need to get a green light to start formation of the captive within the next no later than probably 2 weeks. So theoretically possible, but that would be a lot to get up to speed on and develop their comfort with in a relatively short amount of time.
So if you're hearing this and you think it's sounding like a good idea, I would say don't hesitate to reach out immediately. It's probably, I like to always under promise, over deliver. So, you know, let's just assume it's probably not going to happen this year, but it could if we get moving on this. And I think just to kind of wrap everything up, to summarize, you know, if somebody's listening, who would be appropriate, doesn't matter the industry or sector of the business, but generally speaking, $3 to $5 million of top line gross revenue, $300,000 to $500,000 of net cash flow, appropriate risks, which you guys will, you know, develop with them, and, you know, the willingness and ability to stomach potentially a battle with the IRS, but knowing that working with CIC and, you know, unbridled wealth, Polarity Wealth combination, we could potentially mitigate that quite a bit.
Now, in terms of reaching out, Ryan, how do you do that? Do we reach out to you, or what?
Yeah, that would be the best. I talked to Zulfi and Jonathan. I think if you want to just reach out to me as the point of contact, you can send me an email, Ryan, RYAN, at valeritywealth.com. And then if you want Joe or Buck in the show notes, I can send you my Calendly link. But I think I'd probably be the logical starting place, and then we can go from there.
Right. Well, Sean, thanks so much for your time and and all the information, and hopefully, you know, some people will find this of great use and reach out.
Yeah. Thank you guys. Truly a pleasure. And happy Thanksgiving.
Thanks.
Yeah. Happy
care.
Thanksgiving, guys.
All right.
Take care.
Thank you for listening to the Wealth Formula podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.